All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. It's another video where I'm jumping on, and there is not a trade trigger, and I'm pretty surprised this afternoon. I thought for sure Boeing would trigger, I was so kind of convinced that it would that I priced the options out, know which options, everything, to run with and go with. I even have the order ready to send out, but it is not triggering. Bearish here today, and it has the 3-7 crossover where the 3-day moving average is crossing down below the 7. It has that element associated here with it, and it's a pretty bearish pattern, right? It's quite a bearish pattern associated here with Boeing, but consolidation risk just came in too high as the algorithm kind of goes and back runs a lot of the data and how the stock has performed in similar situations in the past. So it is not a trigger to run with here today, and so it leaves the challenge still in cash. Now I'm going to go talk about a couple trades that are on the board here, and some of the trades that I have made. But this is one where we talked about May tends to be a little lighter in terms of signals. There's a little lighter than I expected, but given everything that's gone on and kind of what we've seen and looking at where stocks are, it's not that kind of unusual or alarming there. I expect we'll have periods like this, from time to time, probably mostly in May and November. But anyway, I will look and react here to the next signal that comes on board. Been nice to see Facebook trigger here today. This is one where when you look at the past history of the algorithm, when Facebook triggers, the performance is really good. It's one of the top performers, but it just hasn't triggered. Today it actually was green earlier in the morning while the market was down. But started to sell off, and it sold off as they announced that they removed 2.5 billion fraud accounts or whatever you want to call them, vacuum accounts from Facebook here. So that weighed on the stock a little bit. That's not a new story, but definitely a weighing story when it comes down to it. So I want to go take a look at a couple things here with you. Take a look at Procter & Gamble, Bank of America. Procter & Gamble from a trade standpoint, Bank of America also from a trade standpoint, but from an option activity standpoint as well. And then answer a question that came in here this afternoon about adding any stock to the model. And let's talk about adding any stock to the model. Because the question said, well, Jeff, we don't have a trigger. What's wrong with going out and buying an Apple, for instance, and that was the example this gentleman used. He said Apple and just applying this ATR method to it. So we just go buy a stock, and all right, if it moves one ATR against us, we go and get out. If it moves in our favor, boom, we take profit and kind of run and go. And it's an interesting concept, right? And it is something that is not lost on me because shortly after kind of putting some of this together, I think it was about a year and a half ago, and I have about 15 months worth of data. I'm looking at the data and I'm going, okay, you know what? Is this really trigger dependent, or can we really just kind of throw any stock into this and kind of see what happens? And we did some playing around. And we started throwing just, hey, pick them, doing a random type of a thing and throwing stocks into it. And there was a severe, degradation in performance, a severe one. It wasn't a little one. It was a big one. And I was kind of surprised. I thought, I expected maybe it would perform a little worse, but, maybe not, as badly as it did. And I thought, okay, is this just time period? Is this just, what the heck is all of this and what can I make from it? But bottom line is, no, I can't throw any stock and I can't throw any signal into this because of the fact that this algorithm is looking for T. It's looking for trend. This is about trend and finding trend and really surviving the chop and thriving in the trend, right? Surviving the chop and thriving in the trend. And that's the whole idea kind of behind this. And so if we go out and just say, well, let's just throw any stock in there, if we're putting stocks that have more probability of going through a chop phase, all we're going to end up doing is getting whipsawed out. Right? This number one's going to trigger a lot. It's not going to mean a whole lot. We're just going to get whipsawed, and it's just going to, eat and erode the challenge value without, really being in a great situation to ride a possible trend here. And so, while, yes, the 3 and the 7 day moving average provide the trigger, and I've been very upfront with that about what provides that actual entry trigger here for the algorithm, it's not the biggest piece of it. The 3 and the 7, that's just simple. That's, I don't want to say arbitrary, but that is just picking, a trigger point to say go, right? And it's one of my favorite. It works out well with the algorithm, and so, run with it. We could go and we could substitute and put another trigger in here. We could use we could use something like a 4 and an 8 day. We could use a 7 and a 20 day, and we'd get fewer signals, and we'd get a lot fewer, but we tend to have a little more accuracy. But the number of signals just doesn't really add up enough to really trade. So, we could go and we could adjust this and make the trigger a whole variety of different things, right? But when it comes down to it, what makes the algorithm or what makes it so we can throw it through this ATR method is the fact that it is looking for stocks that are likely to trend. Now, the way the algorithm works is it doesn't look initially for the triggers. It doesn't say, well, does Facebook have a 3-7 cross? Okay, if it does, then, okay, is this going to be a signal? No. It goes and takes all of the stocks in the algorithm. It takes a look at them and says, okay, what is the trend probability here? And it grades out that trend probability. And the high trend probabilities sort to the top of the list. And then when they match with a trigger, then boom. We have a signal. So right now, Facebook is matching to the high side of the probability of trend, right? And, the likelihood of a trend, we're getting that reading that a trend is very likely. We don't have the trigger direction here just yet, right? That's what we're missing, here with Facebook. And, haven't gotten the downside, haven't gotten the upside. But we do have that, high trend element. Here today with Boeing, we have a trigger element, but the trend element is, still pretty mediocre. It's, not up there. It was higher yesterday. The trend element was significantly higher yesterday than it is today. But it's one of those where that trend element is what makes it. That trend element is what says, hey, you know what? Here's a, I'll go back to FedEx, right? Here's a bear signal on FedEx. You know what? The chance of trend is really high, right? The chance of trend is really high. And, we see this monster trend really kind of play out. And that's what the challenge is looking for and looking to grab and I am looking at reentry possibilities and models here with it, running some real-time tests, but I don't have anything conclusive as far as reentries here just yet. Ultimately, will I look to add them? I will, but it's not a high priority because if I add reentries, basically what do we get? We get more signals, and so if I'm adding reentries, those better be more accurate than initial entries. Because, I could just expand the watch list to get more signals, right? If I jump the watch list up to about 80 right now, we would have a couple signals that, are here on the board today. But, not going to do that, not going to adjust at mid challenge here. So, that's the long answer. The short answer, no. We can't just add any stock to the model. Can't just add anything and go, well, you know what? Here, I like Apple today, and I think Apple's going to go higher. Let me go and trade it, and I'll use the ATR method. You'll absolutely find a lot of whipsaw, with that overall. So hopefully that answers that question. Now let's go take a look at two stocks, and one of them I bought, and the other one I've been debating buying, and I haven't. Let's go to the one I bought here, Procter and Gamble, and I picked this up here this morning, and why? Well, sitting at the lower Bollinger Band. That is it. That's the only reason, right? We have Bollinger Bands that are kind of just, hanging out. They're in kind of consolidation mode. And here we are at the lower band. And, you know me. Those of you who know me, you know my, my itch when something gets to the lower band to want to be a buyer, especially if it's a stock on an upward trend. And we've seen, Procter & Gamble come down to this lower band several times. Sometimes it'll still have a bad day or two and before rallying. But this, that lower band has tended to be a pretty good rally point here for it. So, I bought some Procter & Gamble off the lower band, here today to scratch that itch. I'm not huge in. I don't have a monster position in that I'm married to and expect, hey, this is going to, make or break something. No, I just have kind of a normal position in, and, I'll kind of just take a look. If it looks like it's going to be breaking here, then, I'll pull it off and move on. But, that's where I kind of scratched a little upside itch here today with Procter & Gamble. Now, I've been looking at Bank of America. And, Bank of America is interesting stock, and this pullback, right? And we talked about the banks and the pullbacks and the way bonds have traded, right? And the fact that the yield curve is getting even crazier right now, right? And that has been the catalyst for the pullback in the banks, right? But, when last week when Bank of America dipped below 28, it hit a level that I had told myself after earnings that if it gets down to this level, take a closer look, right? A pullback below 28. And, we saw Bank of America, on earnings just kind of carry on up, pushed up here above 30. And I know at that time, to get to 28, that's unfathomable. You can't, even say something like that because, wow, that's just way too far. It's never going to happen, blah, blah, blah. But, that was in my note. And I said, all right, I'll take a closer look at it down here. Now, what happens? Well, when a stock gets down to a level like this, it never gets there because it's all sunshine and roses. It doesn't get there because it's all good news. Generally, well, almost always, there's some bad news. There's some worry. There's some concern. There's fear, right? That's what drives it. It wouldn't get down here without that, right? And so it's one where you take a look and you say, okay, what's driven it? Well, I understand what's driven it down. The yield curve stuff, the yield curve factors. But I also understand that it's driven now down to a point where it's trading at book value again. Right? We have a stock here with Bank of America now trading at book value. That's what this sell-off has done. It's put it down into a valuation range that is, rather compelling here to me. Okay. And so I've been watching it. I watched it yesterday. I've been watching it here today, and I haven't stepped in. And one of the reasons I haven't stepped in comes into option activity. And let's come in here and take a look as the market continues to sell. But let's take a look here at Bank of America. If we come into this week's options and just look at some of the action that's going on here with them, we saw this action yesterday, where on the 28.5s, we had some big activity here on these options that expire here on Friday. Monster volume, monster activity here on them. Most of it, right? Most of it was what? Most of it was call selling. They were selling calls on Bank of America. Now, whenever we talk about options and option activity, right, people automatically assume, well, if there's a lot of call activity, that must be bullish. If there's a lot of put activity, it must be bearish. But that's just not the case, right? It's what are they using these calls for and what's going on? Well, in this case, they're selling calls, right? And yesterday, if we look at the pricing on these calls, right, they're going for a penny to 2 pennies right now, but we could come in and chart what they were yesterday. And we can see yesterday they were going for about 10 cents most of the day, right? Between 10 and 15 cents when they were selling them. And here you see in the morning all the volume on them as they sold them. This morning, what did they do? They bought them back, right? They bought them back for real cheap, for a penny or two. Well, they stepped in and did the same thing here today. They bought those back, but what did they do this morning? They went out and to this strike lower, these 28s, and they went and sold them. And you can see all the big block volume that came in here. They're selling them here at 10, 11 cents in big blocks. Now, the option price really hasn't changed all that much here today. But big selling here in these options. So you think about it, right? They sold the options, meaning what? Well, they have the obligation. When you sell an option, when you become the writer of an option, a call writer in this case, you have the obligation to deliver the stock at the strike price that you sold the option at, or you wrote the option at, considered the sell side or the seller. So basically, all of these options have obligations associated to them where they have to sell the stock at 28 What does this mean? What does this mean? Well, this means that if there's a big rally, that if Bank of America rallies big, what are they going to have to do? They're going to have to buy the shares. They're going to have to go buy shares because they're obligated to sell at 28. So if all of a sudden the stock starts trading it up at 28.5, right, they've got to go out and buy a whole bunch of shares to be able to turn around and sell them at 28, and they're going to take a loss. They're going to take a big loss. So they're going to start buying shares very aggressively to cover the obligation of these options. And you say, well, why don't they just get rid of the options? Well, they could, and it's going to be a combination of the two. But in many cases, you can actually mitigate some of the losses by going after the shares. And generally, when trade firms are coming after these with such volumes, what we'll see is that if they're wrong, they will come back with shares and look to aggressively buy back shares. And so what happens? He pushes the stock and pushes the stock higher. And it pushes the stock higher in a very rapid fashion. But that's only if they're wrong. That's only if they're wrong, right? That's it. Generally, normally, they're right. And so it's not one of those things where I look and I go, oh, man, okay, you know what? Let me see if I can bet against them and if they're wrong. Now, I've been watching today and going, all right, are there any signs that they're wrong? And so far, no. There are no signs that they're wrong, right? In fact, all signs are that they're pretty darn smart here with what they're doing. But it's a lot of volume on the call side, but it's not bullish volume, right? It's actually a big play betting that, hey, there's just not going to be a big rally, right, here by Friday. That's what they're doing. That's what they're banking on, and that's what they are, putting their money in play for. So I may want to be a buyer of Bank of America, but we have a big player in there who is, doing some of this. And so it's, all right, do I need to step in and buy today? No, I don't. I don't need to step in and buy today. I don't need to be impatient. I don't need to, say, well, let me try to bottom pick, right? I need to let some of that option activity play out. It's not always where, a stock that you're looking to buy has big option activity associated to it. But when it does, it's something where you have to take note and you have to say, hey, what's going on here? Is something happening? We have seen over the last, Friday and yesterday, we saw big option activity in a lot of the energy names, things like Halliburton, big option activity. And where they really push some of the open interest up in a big way, and it's not on the it's not here on the weeklies like with Bank of America, but you can see there's some decent open interest here associated with them. But on some of these monthlies, there's been a lot more open interest, a lot more activity coming in. In fact, today you can see there's 2,000 on the 21 put side versus 77 open interest. That's a big number here for that, right? And I mentioned it yesterday that Halliburton's not the only name that's seeing a lot of activity on the put side here of them. Well, what's going on? What's happening? Well, think about it. I know we get caught up in this mindset of an individual trader, and I have X amount of dollars in my account, and I want to buy puts when something's going to go down. I want to buy calls when something's going to go up. But that's not what the big money is out there doing, right? You think about a big fund who looks at something like a Halliburton and says, hey, this thing's now trading at 23. The fundamentals on this, they're not that good if it's a $30 stock. But at 23, yeah, maybe we want to take some risk here. Maybe we want to step in. So they put together this kind of bullish thesis and say, all right, how do we now get in? Do we just go buy the shares? Do we take that risk? I mean, what if we go buy the shares and 2 weeks later, this thing's at 18? And so they'll do a couple things. They'll say, all right, instead of buying the shares, let's go sell some puts. Right? Let's just go sell some puts. So here in the case of Halliburton, we can come out, and I don't know if this 2,000 volume is put selling, but let's assume that it is. And they can go out and they can sell the 21 puts. What happens? Well, they pocket 30 cents. 30 cents goes into their account. That's theirs no matter what. No matter what. And that is their money. It's a free 30 cents a share. That's more than 1% on the stock, right? It's almost 1.5% with a $20 stock. So already they're in a winning position. They're in the green on the trade. Now, what has to happen? Well, if the stock goes below 21, they have to buy it. They have to buy it. Okay. Are they willing to do that? Well, they've decided that they are. They look at it now and go, well, it's 23. At 21, that's even cheaper. That's even better. We'll take that. All right, we'll take that. That's, it's another 6% lower. Plus, we get the 30 cents at 7%, kind of in our pocket right away. Now, is there some risk? Yeah, there is. Because, now they have to buy it at 21, and if it goes down to 15, they're in a bad spot. But most of the time, put sellers like this, they've kind of done their homework. They've looked at kind of where things are going to get supported. And they've also planned on buying shares around this level too. So they're not just going to go out and sell puts to get into the position. They're going to go out and say, you know what, I'm going to sell these puts. We're going to bank some of this profit. We're going to bank some of this free premium. And then if the stock starts to get down near this level, we're going to add some big buy pressure to the market so that, the stock doesn't tank down below this level and we get kind of hosed on our options. Now, they may not have enough influence to affect that to enough of a degree to avoid a big loss. But most of the big firms, they'll have some, right? They'll have some. And so all this put activity is what? Is that bearish? No, it's actually them setting up a bullish position. Are they super bullish? Is it, do we look at that and go, well, this firm is hugely bullish. Let's go buy call options today because his stock's going to fly. No, not at all. This isn't a super bullish position. This is a really kind of conservative way of stepping in and saying, all right, we like it at this level. We're not sure about timing and everything else going on. So let's put less money at risk. And you know what? If something continues to happen, all right, we'll react and we'll deal with it. So it's not exactly a bullish ringing endorsement of the stock. And when we saw a lot of put activity, or we see a lot of put activity, in things like a Halliburton like this, it's just one of those. It's not bearish, but it's also not overly bullish. Do you really take anything out of it? No, not really. Well, what we also saw yesterday was that there was heavy buy volume in the calls. Not in Halliburton, but in several other energy names. There was a bunch of buy volume in the calls. Well, is that bullish? Does that mean, hey, you know what, they're super bullish? Well, think about a big firm. Think about a big firm. This same firm that it is now setting up, they're selling some premium, they're going to buy some shares. What if they say, you know what, that's too risky. That's too risky. Instead, let's do this. We're willing to risk 2%. This Halliburton thesis, it's nice, but we're only willing to risk 2%. That's it. I don't want to lose. We can't afford to lose more than that on such a kind of flimsy thesis, and it's either going to go now or it's just going to die. So let's go in and let's go and buy the 23.5 calls. They put what they're willing to risk. If the stock surges, boom, they're golden. Now, most of the time, firms will not do this on the shorter-term options. They'll come out to a much longer-term option, a lot of times into the January of the next year, and they'll get into the money, and they'll come in and kind of put a 10% or something like that in it, right? Where it's not those kind of 2% and it happens right here, right now. They're giving themselves a much bigger cushion and a much longer time frame. But is that super bullish? Is that a ringing endorsement on the stock that, hey, everybody wants to buy? No, it's not, right? It's them saying, this is kind of interesting, but could be flimsy, so we're only willing to risk this much, and that's it. That's it. And so we have all this call activity. Is it really that bullish? No, it's not, right? Today we have a lot of call activity. Is it really, that bullish? No. Put activity, is it always bullish or bearish? No, it's not. And when it comes to most call and put activity, it's one of those things where when I start seeing my news feeds, they're talking about call activity in this stock and call activity in that stock and big calls here and big calls there. Most of the time, that's alarming to me, and it says, you know what, there's some trouble there because they're going to the options instead of the shares. Now, that's not always the case. There are those situations where somebody knows something, where somebody knows an announcement's coming. Somebody knows that, somebody knows that J&J is going to get hammered with the court case. And you know what? They go out and they buy deep out of the money puts, and they go big because they're going to make a mint, right? Those happen. But those are a lot fewer and farther between than, this kind of normal day-to-day option type activity. And so, as I look at Bank of America today and, getting back to the original element of Bank of America, wanting to look to be a buyer of Bank of America, am I super eager on a day like today after 2 days of this type of call activity? No, I'm not. Am I watching closely? Sure. Because what do you think is going to happen on a gap up tomorrow? What do you think is going to happen? Is that going to be a gap up that gets sold off, or is that going to be a gap up that all these call writers have to buy into? It'll be a gap up that all the call writers have to buy into, and so this is high on my list to be a buyer of tomorrow morning if there is a gap up. I don't know if there'll be a gap up. There could be a gap down. The stock could go down 10% tomorrow. I don't have a crystal ball or any insight into that. But I do know that if there's a gap up tomorrow, the odds are in my favor joining what I know will be some of the buy pressure that has to come in because of how some of the options traded yesterday and today. So hopefully that helps give a little insight there into some of the option activity here with with stocks. Again, it's not comprehensive. There are millions of different scenarios and different types of setups that we can go and look at, but this is just one of those here with that. All right. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow morning. Take care.